Hey everybody, welcome to this free edition of our Trader Use Group, a weekly roundup for the trading week ending July 15th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is what is the terminal rate? And there's a lot of different variation to it, and depending on which side you're on, is probably going to indicate whether you're more bullish or more bearish. But before we get into that, let's just kind of take a look at where the markets have been and where I think they may be going here short term. So if we look at the Dow performance, S&P, Nasdaq, Russell, the U.S. markets, even though we had a strong finish to the week, we're still in the red for the week. All right, strong finish on Friday, but we're in the red. Year to date, everybody's in the red. Just about everybody's close to a bear market or in a bear market already. Nasdaq, Russell, solidly in the bear market camp. You can see the PE ratios, the trailing PE ratio 20.57, but the key forward PE ratio is at about 16.43. It's lower by a little over 20%. Dividend yield in the S&P sitting at 1.68%. 10-year Treasury 2.93, so it's about 125 bips higher than the dividend yield. The S&P earnings yield is sitting at about 5.3%. And we're getting a yield S&P over the Treasury of 2.37. But when you take out the inflation, then the real yield is a minus 3.8%. Current VIX was about flat for the week, about 1.67% net change, coming in at 24.23 versus the prior week's close at 2464. So not much of a change there. You can see the best performer for the week is still a risk-off sector, staples, almost flat. The worst performer for the week was energy, down 3.33%. Energy still leading the way, by the way. Year to date, 26% up. Discretionary is also the worst, bringing up the rear at 28.88%. So, as I said, major indexes finished lower this week, despite this solid finish we had this past Friday. And we saw stocks touching the lowest low since June 22nd, this past Thursday. And then we had that sharp rally, of course, on Friday. Anticipation over the week's really important inflation data kind of dominated sentiment most of the week. We saw CPI coming in a red hot 9.1% over 12 months, and we saw the market sell off immediately. That's the highest rate since 1981. Prices jumped 1.3% in June, and then followed up by the PPI, which came in a lot higher as well. So we had these back-to-back numbers that kind of put the fear in the market, but they started to back off right away, especially going into Friday. The first issue was that the markets immediately priced in a 100 BIP, which is a 1% rate increase for the Feds on July 27th, and immediately backed off when we had one of the Fed governors come out and say 1%. He doesn't see that, but clearly a 75 basis point rate hike would make some sense. So that, and we also saw a preliminary survey of consumer sentiment. Most Americans feel the 5-year inflation expectations are going to decline sharply. So that's kind of feeding the narrative. We don't need 100 basis points, maybe 75. So the market's kind of reversed course off those hot CPI numbers. And we did see consumer sales come in strong so far. So the consumer still has a strong balance sheet, doing fairly well. I do believe that the current forward earnings per share estimates are still a little bit robust, a little bit high. They're at about 230 points. I don't think they're going to come in that high. I think they're going to be revised down, and I think we're going to see a downward revision in the earnings per share, as well as an upward revision in unemployment. So we're going to see some of that coming in the second half of the year. All right. The other thing on the U.S. Treasuries, the benchmark 10-year fell over the week and created an inversion between the 2s over 10. That would be the 2-year over the 10-year Treasury. And that's considered by many to be a big recession signal. It reached its widest level since 2000. So a lot of analysts are saying we're probably already in a mild recession, not a tough one, but a mild one. I think I'd give it a 50% chance we're probably already in a mild recession, but we're going to know pretty soon when we get the first pass of Q2 GDP. Uh, One other interesting point, the current Fed fund rate is sitting at 1.5 to 1.75%. And you notice that I said what's the terminal rate? Well, the markets, the Fed fund futures right now are pricing in a terminal rate at the end of this year at 3.5 to 3.75%. Okay, that would imply an additional rate hike of 2 to 2.25%. And given that we've got four more Fed meetings coming up before the end of the year, that would average almost 50 bips per meeting. Okay, so we're going to see how all of that shapes up. Now, if we come over and look across the pond at Europe, we saw that Russia closed their Nord Stream 1 gas pipeline supplying primarily Germany for maintenance, quote unquote, until the following Friday. So Germany and the government there is concerned that Russia may not fully reopen it once they come back online again in retaliation for a bunch of European sanctions. I would say you could probably count on that, take it to the bank. Russia's trying to play games there with that, but you know, the politicians, they set themselves up for this. I don't know why the people keep voting these knuckleheads in, but they do. So you know, they're going to be freezing their asses off this winter. Summer, they're going to be hot as hell. So that's what's going on over there. Also, the European Commission, speaking of economic forecast for Europe, they lowered their economic forecast due to higher inflation, and so their their summer forecast for GDP is revised at 2.7%. They're taking it down to 1.5% for 2023 instead of 2.3%. So they're cutting a lot their GDP. Also, inflation is predicted to accelerate roughly to about 8.3%. This year, up from a previous forecast of 6.8%. And the rate for 2023 was also raised to 4.6%. So the European economy is in more dire straits than the US economy. And then if we look, you can see that the Euro stocks, the FTSE, and the DAX all finish in the red, but most of them are around break even. The only green we saw across Europe was the CAC 40, the French index. But you can see year to date, they're still not doing very well at all. And then, of course, we go over the Asian markets. You can see Bank of Japan, their governor, Kuroda, he reiterated their commitment to ultra loose monetary policy, saying that he's not going to hesitate to take additional easing steps in that economy if necessary. So that tends to help money, as you know, at least as long as the markets allow it to be so. So the Bank of Japan's dovish stance also is creating this aggressive tightening, or against the aggressive tightening, I guess, is probably a better way to say it, with the U.S. Federal Reserve, is why the yen is continuing to weaken against a very strong U.S. dollar. All right. I think the yen is hitting a low against U.S. dollar of 24 years, going back a couple of decades there. Meanwhile, the Chinese markets, both China and Hang Seng, finished solidly in the red, in correction territory. The Chinese stock markets eased just a little bit as data revealed the country's economy slowed sharply in the second quarter. Well, no shit, Sherlock. They shut down in March, and they've stayed shut down for over 7 or 8 weeks. This zero COVID policy, again, in my mind, does not make sense, but, you know, the people are going to suffer while these knuckleheads run the country. China's GDP for June also grew at a worse than expected 40 basis points from a year earlier. That's almost no growth at all. So we're going to see how all of this stuff really shakes itself out. It's going to be interesting to play this number out. And of course, if we just take a wide step back, you can see here, and I've shown this before, number of bear markets that we've had since the 20s. And I broke it down decade by decade. So you can see the number of bear markets, and then on the far right, you can see the average bear market. You get about a 20% chance of a bear market on any given year. Each decade's average a little over 2 bear markets a decade. So having a bear market is normal. About every 5 or 6 years, we have a bear market. Normal. You can see the average length of the bear market. The first number is days, second number is months. Of course, in the 2020s, you can see we've now had 2 bear markets because we entered the second one here this year. The first one was a very fast 32 days with COVID, 32, 33 days. And this one, we haven't, you know, we didn't enter at the beginning of the year when we went into bear market 20% down. It wasn't that long ago, a little over 30 days ago, I guess. So that's kind of where we're sitting. Then you can see we've had a total of 27 bear markets. The average decline in a bear market on the far right at the bottom is about 35%. So the most we've been down thus far is 24%. So I am expecting, and I've revised lower our range. I was at the 37 to 3,800. I've had that range for about 4 months now, and we've hit that nicely, and then we've bounced up, and then we've rolled back over again. Okay. I think I lowered the range. I said that June we would finish to the upside, and then July going into August has a propensity to be a little bit ugly, but very choppy. And then it's going into September, October. It could also get very ugly then as well. Okay. So just understand where we're sitting with these markets. I'm going to shift the screen over right now. Take you guys over to the charts. Let me get over here like this. Let's get this thing up here. So it's going to take a couple of seconds to get over here. But what I'm going to show you, the first thing you're going to see is the E-mini S&P 500 futures. And you're going to see a daily chart of the futures. And if you look at this, you can see here that we hit the 2022 low back over here on the 17th of June, and we were down 24.32%. So this is the futures market. I know the cash index, SPX, is slightly different than these, but it's pretty darn close. And you can see we've been kind of running sideways in a little bit of a camel hump kind. We're just not going anywhere. And these railroad tracks up here represent, let me just clear it up so you guys can see it, represent a rare gap in the E-mini futures where we closed here and we opened down here. So you don't usually see a gap like that. It was a pretty good little gap. And now that gap, we filled the gap by testing it. We could not, and these are daily bars, we could not maintain it. There was no follow through and we rolled over. That was my original target down here, sitting around 37.30. And we hit right in the middle and went just slightly below it. Then we challenged the gap again and we gave it up, and now we're coming back up again. Okay. So these are the challenges that I see in the market. We've got to take this gap out. This is the 50 EMA, as you've heard me say many times before. You can see the delta between the 50 EMA and the 200 EMA. And it's very wide, and this is a bear market. Anytime the 50 EMA moves below the 200 EMA, it gives you that bear market. And you got to trade the chart like a bear market chart until it's not a bear market chart. And what's not a bear market chart? In real simple terms, you want the 50 EMA to be over the 200 EMA. And I granted it's a lag because sometimes the markets can be up 15% off bear market lows, 18% off bear market lows, even 20% off bear market lows before you get across. That does not say you have to sit on your hands and not trade the upside as it's moving up, but really you need to clear these technical hurdles to get the bear market moniker off the chart. Okay, so until then, you can see over here how you come up and you challenge the 50 EMA and you just cannot get any follow through and you roll back over again. So I suspect we're going to have another challenge at the 50 EMA around 39.60. This challenge, the 50 EMA, was sitting at a fib node of 41.75 roughly. So we've got this challenge here. Should we pass this challenge and have follow through, we should run up to this area up here just south of the 200 EMA, and we'll see how the markets play themselves out. Okay, so that's a little bit about what I'm looking at here. And then of course, if we come over here, I haven't shown it in a while, but if we look at the Andrews Pitchfork, you can see here, and this goes back there, these are key pivots. This key pivot here was back in 2018, right before Ballmageddon. And then we got a pivot point high here back in February of 2020 before COVID. Then we got a COVID low, and these form the major pivots. This is a weekly chart of the SPX. Okay, and you can see we came right down and hit that blue line, which is the midpoint of this Andrews Pitchfork. I would consider this would be a secular bull trend. Now we do have cyclical movements here, so we're in a cyclical bear market within an overall secular bull market, if that makes sense. All right. And I had said we can come all the way down to the 3,500 area, which gives us right at a 50% move off the highs here that we made back in January. All right. So that to me would be a normal pullback in the markets. And if we do hit that level, just to give you an idea of um, the the pullback range, let's just take it all the way down there, and that puts us down not too aggressive, but right around the 3,500 area is about a 27% pullback. To give us that average that we've had over the since 1920, we would have to see the markets come down around 3150, and that would give us that 34% pullback. So we're in a what I would consider to be not a wild bear market, but just a very orderly move lower. Orderly because every movement up has been met by sellers coming in and pushing it back down again. And you can see where we're sitting right now. Now, if I wanted to show you another version of this chart, let me come over here and look at this one right here. It's a Dawn-Shin channel, and you can see, not counting this last move right here, we've had 7 bull trap rallies. The average percent move since January 1st has been about 7.7%. The number of days is 6. The average point move is 312. So if you come over here, you can see this big move off this bull trap was over 500 points. Okay. Over here is 244 points, another 244. Here's one that was almost 400 points. This one was 307 points. This one moved up here about 306 points. So I'm sorry, 307 roughly. So we're staying in average here. You can see how the Dawn-Shin channel, which basically each line represents the high and the low of a 20 bar look back, in case this is a daily chart. That's 20 days, so roughly about a month. And you can see how they're tightening up. We haven't made new lows, but we're making lower highs. So we're winding up here. And we're winding up into a Fed move on the 27th. We'll probably get first pass of Q2 GDP. If it comes in negative, we'll probably break the lower boundary here and go lower. That'll show we're in a recession. And it won't tell you whether it's a mild recession or turning into a stronger one, but it would define, at least initially, that we're in a recession, right? If we break to the upside, then the Feds will probably be less aggressive in the hiking rates. If we break to the downside, they may be more aggressive. But it's going to be really interesting to see how this stuff plays itself out. Okay, so these are just some of the things that I wanted to discuss with you guys in this weekly roundup. All right, these are really key numbers that you got to pay attention to. And of course, if we look at Nasdaq, because a lot of folks follow Nasdaq. Let me just find it here. Nasdaq was up almost just slightly under 2% on Friday, but still down for the week. You can see we hit the low point in Nasdaq back on June 16th, and it was down almost 34%. You can see we're also below the 50 EMA. And we cannot seem to get up above these key levels. We've got to clear the 50 EMA and then see follow through action, or see the 50 EMA hold before we can come up and challenge prior pivot points. Otherwise, the seller is going to win out and we're going to just come right back down again. I think over the next 60 days, we'll be lower than where we are right now, but there's going to be some good bull trap rallies where you see the S&P move 3, 4, or even 500 points, as I showed you earlier, that happened this year. And yet, price action just rolled right back over again. And I think that's what we have to look forward to. So in any of these bull trap rallies, you want to be repositioning your portfolio and you want to be taking advantage of it. And you could do swing trades or intraday trades to the upside in a down cycle market. And that's a little bit about what some of our members are doing, or at least what I'm suggesting. But that's kind of what I'm seeing right now, folks. And of course, if we come down and look at the VIX is obviously down to 24.23. You can see where we're sitting here. We actually moved below the 200 EMA on the VIX, so that's a good thing. I want to see it hold up. I want to see the 50 start rolling back over and cross back below. But I think it's going to stay at a minimum elevated through the end of this month. We got to get through this past week we saw bank earnings. They didn't come in that great, okay? But the banks, all of them have such a low bar and hurdle rate to cross that they could come in and miss and still move higher, all right? And so we're going to get about 70 some odd companies next week. We're going to get the Fed's coming out the week after that. So we're going to get some key data, and that's what's going to move the VIX. So just be really careful where we're sitting right now with volatility, because it could move up or down depending on where this economic data hits. And of course, if we look at the bond market, you can see Friday it was up 20 ticks. You can see it is moving up, taking out the 50 EMA. Now I'm going to be looking for follow through here too. This would go in line with my consensus and a lot of analysts that say the interest rates are going to slowly come down. This is the 10-year, or I'm sorry, the 30-year. The reason why the interest rates are coming down, because when bonds move up, interest rates go lower. So when bonds move up and interest rates are selling off, that is not a good vote of confidence for the economy the next 12 to 18 months out in time. Okay. So we're going to see this thing. Now, we made a lot of money in the bond market shorting bonds back over here. This was my area where I said we need to short the bond market. Okay, and it just rolled over, and it gave a nice trade for folks that know how to play either bonds or some of the ETFs that track bonds. Okay, great trade for us. But now I said just wait for a rolling number higher, and then we'll see how this thing sets itself up. Okay. If we look at interest rates, it's going to be just the opposite of bonds. You can see how rates, it came up. My original targets for rates was around 3.3%. It actually moved up to 3.48 and then sold off, and now we're sitting just slightly below the 50 EMA. I do believe and this is the 10-year interest rates. I do believe the 10-year rates are going to come down a little bit more and finish lower on the lack of confidence of the economy going into 2023. Okay, so that's why the rates are selling off, and the notes and the bonds are moving higher. Okay, if we come over here and look at the U.S. dollar, well, it's been really strong except for Friday. You can see right here, and I just got to move it up here to show you just how strong the dollar's been. Okay, there is no divergence in the dollar. That suggests any move lower is probably going to be bought. And typically that pattern looks like a 3, 4, 5, and then you get like an ABC chop pattern. And then it either changes direction or it goes and it resumes the original direction. So looking at the MACD, that just tells me that there was a lot of buyers coming in here. So I think there's the boat's starting to get crowded on the long side. You have to be careful there, because if it starts rolling over, you're going to have a lot of capitulation and selling very quickly. You can see how the 50 EMA is holding up the US dollar index. Remember, it's the dollar index. It's not the dollars. So the dollar index is based on a number of different currencies that drive the value of the dollar index. Primarily the euro, excuse me, the euro is about 58% of the dollar index. The yen, almost 14%, and the pound is about 12%. So you just add those three up, and that pretty much tells you where the dollar is going to go. And if the dollar is going up like this, well, then by the same token, the euro and everybody else is ugly. So if we take a look at the euro as an example, you can see the euro came down here and hit a low on July 14th at $1 to $1. It hit parity low intraday on the 14th of July. Now it closed out at 101, right? So it's still, for those of you that want to travel to Europe, your dollar is going to go a lot farther right now, because the euro used to be a lot higher, right? It's just fallen off a cliff, because the estimates are that, first of all, the ECB is not hiking the rates as much and as aggressive as the Fed. So number two, there's a lot of analysts out there that feel that Europe is already in a recession. So we'll see how that plays itself out. And of course, if you look at the other one that's just cratering here, if we look at the yen, look at this. This is ugly, folks. We haven't seen this in quite some time. It is very ugly. It is still a bear market chart, and until we get the yen crossing the 50 EMA and it holds, well, then that would be where it would be worth maybe taking some longs. Yen has always been known as the widow maker when it starts falling, and longs are going, okay, it can't go any lower. Let's play it to the long side. And of course, they get taken to the woodshed. It's constantly moving lower, so we have to be careful here, okay? For those of you that like the currency play. And then a British pound. Look at the pound. It's down 118 to the dollar. Before Brexit, it was up over 158, 160. Now it's down to 118, right? And again, it's because Europe was just not prepared for the Russia pipeline issue. The European folks were not prepared for a lot of the way they were doing their border and migration, the way they run their economic policies and business. It's going to fare worse than the U.S., I believe. So that's why, and again, we got a bear chart. The 50's below the 200. Okay, so just not very good right now. Of course, if we look at gold, I had said here on this weekly roundup that gold's going to be moving lower. You could see my original target was about 1759, 1760. We actually came down and hit this downsloping trend line right here, right slightly under 1700. So just remember that if we move back up, that's going to be the overhead resistance right there. Right. We do not have any divergences on the MACD, so that tells me that any move higher, the odds favor a rollback over again. Excuse me. So gold and silver are the same, right? A lot of people thought gold would go a little bit higher. Excuse me 1 minute, guys. I just have to mute my mic for just 1 second here. Hang on 1 second here. Let me just see if I can get this squared away. Sorry, guys, I got something stuck in my throat. So a lot of people thought gold would go back up over 2,000 as a hedge against inflation. I was kind of one of the few that was saying you got to keep shorting gold, and this is just what it's done. All right. Same thing with silver. I do like silver to the upside when I'm ready. It's not ready yet. You can see we're just going slowly lower and lower and lower with silver. All right. So silver hit a low here on the 14th of July, 18 and a penny, right? $18 and a penny. If we look at it, there's just slight, ever so slight chance of a bullish divergence, but I want to see this thing clear some of these key levels before I'm looking at going long. Okay. Now let's look at oil. Excuse me. Looking at oil, it finished strong on Friday, but you can see it's kind of come undone, as most commodities have. All right. I do believe commodities are going to stage a little bit of a comeback here. You can see where and this is a bullish chart, we broke the 50 EMA. We tried to regain it, no follow through. We found support at the 200. We tested it again with strong support. That suggests we can run up here, break 100, and challenge the 50 EMA again. We may not make that challenge and we'll roll back over again. That would be another opportunity to short. Right down here, I wouldn't short it. I would wait and see what it does around the 200 EMA. Now, like gold, we have a special way to trade oil in the futures market, and it works out very well for us. So that's just something to think about. Our members are making money with oil if they know how to, we have a special way of trading that works out nicely. And of course, if we look at nat gas, we're making good money in nat gas as well. It had a strong day on Friday. You can see how we did have some follow through in the 200 EMA, but nat gas is much more volatile. And then it reversed course and moved back up over the 50 EMA. If it can hold the 50 EMA, it's going to run a little bit higher. Right now, the charts seem to indicate it's going to roll back over again and come back down and test this 200 EMA, possibly test these lows here. But both oil and nat gas is so highly dependent right now on Russia and Ukraine and what Russia's going to do. So, and we were going to be getting the Freeport-McMoRan LNG terminal back up and running in the next week or two, and that's going to further export nat gas from the U.S. So that should add a little bit of a bullishness to the natural gas futures contracts here in the U.S. All right, everybody, that's kind of where we're sitting now, very quick and dirty. Members, I will see you this Sunday evening, and we'll go a little bit more detail on some of these things. And I've got a list of probably about a half a dozen, I think, good asset plays that make sense right now. Okay. Have a great weekend, everybody. Members, I'll see you guys this Sunday evening for our weekly market watch. Ciao, folks.